title of our big picture article this quarter is The Right Price. And at the heart of the article is really Warren Buffett's quote, "For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments." And really we try to test this thesis in the article. In terms of performance from stocks, there are effectively three drivers of future returns. The one is the price you pay. The second is the sustainable growth rate that the company generates over time. And the last is the amount of cash it produces as it delivers its annual earnings. But interestingly enough, price is the only thing we know. And for simplicity's sake, we use the PE to represent price or value, current value. For most markets currently, they trade well below their historic average PE levels. So from a forward PE perspective, we look 1 year out on markets. The US trades at a 48% premium to its long-term average. Japan looks relatively cheap at only 8%, and the UK at 6%. So those are the two standout markets, but the world as a whole trades at a 40% premium on a 1 year forward PE compared to its long-term average. We also understand that P's can be distorted by depressed earnings. That's typical of what would happen during a recession like 2020. Hence the use of a forward PE to do our analysis. So what were our findings when we looked at PEs over time? Well, interestingly enough, any PE above 24 on world markets tends to give poor prospective returns. Anything below that, there's a high probability of decent future returns. We know that world markets basically are very high at the moment and trade well above that historic PE of 24. So how do we deal with that at North Star? How do we deal with such expensive markets? Well, the toolkit we have is mainly that we run flexible products. And it gives us an opportunity to downweight and upweight equities as we deem fit based on our valuation work. So with markets quite expensive at the moment around the world, we've obviously downweighted some of our equity exposure. I think another point worth noting is prospective returns also a function of GDP growth, nominal GDP growth. Companies need to grow, and they need to grow with a growing economy. And although GDP growth is expected to be very strong for the next 2 years around the world, prospective returns or nominal GDP growth after that is in doubt. So we have very expensive markets which are unwinding. That expensive nature is unwinding over the next 2 years, but they remain expensive compared to historical trends. And we're concerned about profitability levels based on poor or lower GDP growth after the next 2 years. So our toolkit becomes extremely expensive at North Star. And the thesis of the article really is that Warren Buffett's quite right. Buy stocks that are too expensive, even with great economic conditions, leads to poor returns.